Today, the long, slow crunch. The DFA Daily to the 6th of May 2020. Hello again, I'm Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. So far, Australia's big four banks have had a savage results season. Loan impaired expenses across NAB, ANZ and Westpac increased by 226% to $5.7 billion, and CBA has yet to report its results. And actually, there's considerable uncertainty in trying to estimate the final costs of impairment expenses. They will remain sky high through the rest of 2020 and probably 2021. But as they struggle to turn their Royal Commission reputations around, the worst could be yet to come, says KPMG. While the majors have proven resilient so far, it's too early to estimate the full impact of the COVID-19 crisis on their 2020 performance. The majors will have to contend with the demands of customers who want relief from loan repayments, a government which wants credit made available, a regulator which wants unquestionably strong balance sheets, and shareholders who want strong profits and dividend payouts. And EY's outlook for the Big Four is similarly bleak, with the sharp and possibly protracted decline in the economy likely to mean substantial earnings headwinds in an environment of unprecedented uncertainty. We are still in an interim period where the banks are not yet aware what the full extent of those losses will be, said EY. Many customers have taken advantage of repayment holidays, which makes determining the true scale of potential delinquencies hard to predict. And while the Big Four have made considerable progress on cultural changes, including the removal of a number of C-suite figures tainted by the Royal Commission and the overhauling performance-based remuneration, the current crisis threatens to turn that around. The banks face a substantial challenge in how they balance the competing needs of customers under financial stress, with prudentially managing capital to remain able to provide ongoing credit support to the broader economy. Not all of the bank's customers will recover from this crisis, driven by the surge in unemployment and reduced consumption, and the banks will be further tested on the trust equation based on how they work through defaulted loans and access collateral. APRA and ASIC leaned hard on the banks to defer or pay reduced dividends in order to stay well capitalised in the face of the ongoing economic uncertainty. Both ANZ and Westpac deferred a decision on interim dividends, while NAB paid a reduced dividend. But a return to their usual high dividend payout levels is unlikely to happen anytime soon. The banks are engaged in a delicate balancing act between the needs of shareholders, particularly retirees who rely on dividend income, and maintaining capital. While banks are generally reluctant to reduce dividends to shareholders, this half-year cycle has seen a combination of reduced and deferred dividends and issuance of capital as they batten down the hatches for the changing climate ahead. And John McGrath, the founder of McGrath Real Estate Agents, said that stamp duty can limit people's choice when life circumstances change. The Reserve Bank Governor's recent suggestion that we reform land and property taxes as part of a broader COVID-19 recovery plan has once again highlighted the negative effect that stamp duty has on our ability to move house when our life circumstances change, he said. Governor Philip Lowe said, "As we look forward to the recovery, there is an opportunity to build on the cooperative spirit that is now serving us well, to push forward with reforms that could move us out of the shadow cast by the crisis. The first of these economic reforms should be the way we tax income generation, consumption and land," he said. And over the weekend, New South Wales Treasurer Dominic Perrott said abolishing stamp duty would form part of his proposed plan for the state's economic recovery from coronavirus. Mr Perrott was quoted in Saturday's Sydney Morning Herald saying, "There is no better time to rid the states of inefficient taxes that hold back economic growth, and I am talking stamp duty and payroll taxes. Stamp duty is easily the worst of the taxes that residential owners have to pay every time they buy a new house. It's calculated on the purchase price, and there's been little change to it, despite prices rising significantly over the past 3 decades. The median house price in Sydney in 1990 was less than $200,000, on which you'd pay around $5,500 in stamp duty. Today, it's above $1 million, and the duty is more like $40,000. As a result, many families are living in cramped environments or far away from their work or their kids' schools because moving is simply too expensive. And data shows that people are staying put longer in their current homes, and this has implications for society. It means family homes are not being released to the market by single or couple empty nesters who would like to downsize but don't want to pay this prohibitive expense, which punches a huge hole in their retirement savings for absolutely no reason. And younger buyers typically have to borrow the funds to pay the stamp duty, which adds tens of thousands to their loan, which they will then pay interest on for many years. Nobody in government, on either side, wants to talk about this because they are completely addicted to the billions of dollars in revenue that stamp duty brings in every year. Dr. Lowe's comments resulted in a chorus of criticism on stamp duty in the media. In a story published on domain.com.au, AMP Capital chief economist Shane Oliver describes stamp duty as a terrible tax. It's a massive impost on a single transaction which exhibits economic decision-making. It should be repealed, and this is the perfect time to do it. In 2008, a Grattan Institute report on housing affordability recommended replacing stamp duty with a broad-based, flat-rate land tax. Long-term, reform will create benefits for the economy and boost the gross domestic product significantly, said economist and report co-author Trent Wiltshire. The ACT government is leading the country on stamp duty reform. They began phasing it out in 2012 under a 20-year plan and raised rates for all property owners instead. Currently, a medium-priced home in Canberra will cost you $700,000 with stamp duty of around $20,000, which is still high but better than the $32,000 you would have paid before the reform in 2012. By comparison, stamp duty on the same property in Sydney would today be $27,000 or $37,000 in Melbourne or $70,350 in Brisbane. McGrath says it's high time that other states and territory governments start embracing ideas for reform of this tax, not just because it's the right thing to do, but also because an ongoing reduction in housing turnover means fewer sales per year and ultimately fewer stamp duty payments. Over time, if the revenues from stamp duty drops, they might finally be motivated to reduce or abolish stamp duty to enable and incentivize people to move house as often as they need. To which I reply, yeah, but elsewhere when stamp duty is removed, prices rise on average by close to the same amount, so it's actually a zero-sum game. And in addition, the $8 billion that New South Wales currently raises from stamp duty would need to be recovered from other taxes like, for example, a local GST or higher land taxes or state rates. Such a reform simply moves the problem. It doesn't fix the issue as far as I can see, so I would say be cautious about these reforms, which are designed more to stoke the property market than for any other reason. And the HIA says support for display homes is an important step in recognition by state and territory governments over the last fortnight. Allowing new home buyers to visit display homes and villages has been a sensible and important move, said HIA Managing Director Graham Wolfe. Visiting display homes is a first and exciting step for aspirational new home buyers and their families. Access to display homes is equally important in supporting new home builders and the housing industry more broadly over the coming weeks and months. The housing industry is continuing to implement the various government measures needed to ensure community safety by limiting site access and managing customer contact. Hygiene and social distancing measures will continue to apply. Builders readily manage entry and access to a display home, keep records of visitors, and ensure the home is safe and clean at all times, while adopting measures similar to the access restrictions placed on open house inspections. New home builders have experienced a significant downturn in traffic through display homes since the crisis started. It is important now that home buyers understand that they can visit a display home or a display village, and they can be assured that their safety will be protected by the builder when they do. The HIA has provided the residential building industry with the Making Space on the site COVID-19 Safety Toolkit. And the toolkit now includes 8 industry guidelines and consumer guides in 5 languages aimed at assisting our industry to keep their staff and their customers safe, they said. HIA's guide for display homes in WA, NT and New South Wales are part of this toolkit. Now, over in Europe, as Moody reported on 28th of April, the European Commission adopted measures to help banks maintain their capacity to absorb the coronavirus pandemic's costs and still extend loans. The measures include an interpretive communication on the European Union's accounting and prudential frameworks, a so-called quick fix amendment to the regulatory capital requirement. The measures will not add any economic capital, but it will boost banks' common Tier 1 equity, CET1 ratios, all other things being equal. However, they will be credit positive only to the extent that they reduce the risk of supervisory intervention. The measures consist of three broad pillars. The first officially endorses recent regulatory guidance by the European Central Bank, the Basel Committee on Banking Supervision, the European Banking Authority, and the International Accounting Standards Board, among others, particularly with respect to implementing the International Financial Reporting Standard 9. It also postpones the final provisions of the Basel III framework. The EU strongly supports banks' use of capital and liquidity buffers where needed and has urged market participants not to take a negative view should banks use them. The second pillar includes provisions anticipating the implementation of rules embedded in the CCR, which will be enforced in 2020 ahead of its scheduled implementation in 2021. The provisions include preferential treatment for exposures to small and mid-sized enterprises, certain infrastructure projects, salary-based lending, no deduction of software from CET1, and a revised definition of the leverage ratio, which for 1 year will no longer apply to banks' exposures to central banks. In addition, the timeframe on minimum provisions for loans that benefit from government guarantees will be aligned with that for exposure guarantees by export agencies. Under this regulatory framework, which is a backstop to IFRS 9, banks' exposures to such loans will have to be fully provisioned only after 7 years if they become non-performing. This measure could give banks more time to account for credit losses unless they decide otherwise. While gauging the measure's cumulative effect is difficult, banks' capital itself will not change, and they believe that the measures will add only a few basis points to banks' CET1 ratios. Furthermore, this revised time frame could delay recognition of losses incurred on bad loans, which is negative for market confidence in banks' balance sheets. The third pillar amends the prudential treatment of IFRS 9 to further reduce the standard's effect on banks' CET1 ratios. A number of banks in 2018 opted to phase in the initial application of IFRS 9 between 2018 and 2022. Those that opted to front-load the application will now be allowed to reverse their initial decision. The time frame for IFRS 9's initial application has been moved to 2020 to 24. The Bank of England also on 26th of March encouraged banks, as permitted under CRR, to make use of the transitional arrangement on IFRS 9. And the European Commission has also decided that the additional IFRS 9 provisions' effect on banks' CET1 ratios will be fully neutralised in 2020 and 21 for banks reporting under the transition measures, which could materially affect some banks' regulatory phased-in CET1 ratios. It's unclear whether the largest EU banks, many of which opted to front-load IFRS 9, will now reconsider their choice. Although the official sector's guidance on IFRS 9 should not result in significant shifts in provisions, the European Commission is moving to preemptively address this risk. The measures have been submitted to the European Parliament and the European Council, and the legislation is expected to progress and to be fast-tracked, and that the package therefore will be quickly adopted. Now, just pause there. What this is saying is that in a time of distress, the regulatory frameworks are being loosened to give banks more wriggle room. And we're seeing that around the world. The Fed announced something quite similar overnight. It's a bit worrying, seems to me, that in a time of crisis, we should be tighter, not looser. But there you go. I'm not a central banker. Now, lending figures from the ABS may be just academic, actually, for March, because, of course, it was before the COVID. Housing finance approvals held up better than expected, up 0.2% in value terms, despite a 2.5% fall in investor loan approvals. This is a throwback to pre-coronavirus, of course, reflecting the strength of conditions earlier in the year. And there are significant lags between the application and approvals, which helped to support the firm results. There's going to be a steep drop ahead, of course, particularly from April onwards. And it's interesting to note that the detail was quite soft as well. The number of unoccupied loans declined 0.9% over the month, and construction-related finance approvals recorded a more meaningful pullback. The number of unoccupied loans for construction fell 3.6%, and the number of purchases for recently built dwellings fell 4.5%. That said, the latter was coming off a very strong gain over the previous 3 months and is still up quite a lot over the year. First-time buyer loan commitments increased 1.3% in season-adjusted terms, while the number of first-home loan buyers for investment purposes actually were 4.2% of all first-home buyer commitments in original terms. Finally, owner-occupied first-home buyer loan commitments amounted to 31.8% of all owner-occupied commitments, excluding refinancing, and in original terms. So, not bad lending results, not particularly good, but they'll be weaker ahead. And retail sales for March came out, and also for the first quarter, with much of the spectacular stockpiling-driven surge in March monthly nominal sales due to prices rather than volumes. Indeed, the monthly result was revised up from a preliminary estimate of 8.2% to 8.5%, led by a spectacular 24% jump in basic foods, considerably bigger than the 15% jump we normally see around Christmas. Other retailing, which includes pharmacies and stationery and home office supplies, also recorded a big 16.6% jump. On the other hand, cafes and restaurants and clothing retailers saw a 22% drop. Sales likely cratering late in the month as social distancing restrictions came into full effect. For the March quarter as a whole, nominal sales rose 2.7% over the quarter. However, most of this was due to higher retail prices. The retail deflator was up 1.9% over the quarter, the strongest quarterly rise since the GST introduction in September 2000. That was much stronger than the CPI detail, which pointed to a 1% gain. The result has likely been skewed by the big compositional shift in spending, with a big jump in spending in segments that likely saw stronger price gains in the quarter. Notably, prices jumped 2.6% in the quarter for basic foods, but were up just 0.3% across other categories on a combined basis. The bottom line is that real retail sales rose just 0.7% over the quarter, which was well below the expectations of 1.8%, and that in turn removes considerable upside risk to the wider consumer spending measures in the Q1 national accounts, due to be released on June the 3rd. While the retail figures highlight the complexity of this impact of COVID at this early stage, there is little doubt that retail sales and wider measures of consumer spending will show a materially weakening as the full effects show through in the June quarter. And as part of their announcements this week, Westpac has committed to exiting thermal coal mining by 2030 and will not establish new relationships with thermal coal customers, limiting support for the industry to existing basins. The bank has also set an emissions intensity target for power generation lending of 0.18 tonnes of CO2 per megawatt hour generated by 2030, effectively make it impossible to finance new coal and gas power plants. Westpac's policy is another nail in the coffin of the thermal coal industry, and a stark warning to a federal government trying to leverage the COVID-19 pandemic to give the fossil fuel industry a leg up. And Commonwealth Bank has indicated that it will be temporarily closing up shops across 115 branches with 500 staff, moving to major centres and to increase online support teams. CBA reported calls to its hardship line increased by 800% since the virus crisis kicked off, while visits by customers to bank branches had fallen by more than 50% as people have adopted social distancing and lockdown requirements. The branch staff transition is set to take place on Thursday, with closures primarily in the metro areas. Since the pandemic was declared in early March, we've received more than 1 million calls and online requests for help, a spokesperson for CBA said. Transaction volumes in branches dropped significantly, and there has been a large increase in customers doing their banking online. Now, some, including myself, would suggest that we are going to see more branch closures ahead because of the drift to digital, which is now turning into a torrent, the removal of cash from many different situations, And of course, the banks continuing to push for cash-free environments. The ban on cash would have been a nice little way to do that, but I suspect that we will see banks continuing to push people onto other channels and away from cash, and from other channels away from branches. Welcome to the digitalization of the financial system. So standing back, it's clear that the echoes of COVID are casting very long shadows over the finance sector and the economy more broadly. And as Frydenberg said yesterday, we have yet to see the worst impacts. The June quarter will be horrid, but beyond that, the chances are we will see those echoes continuing into next year. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.